share with you a little bit about our speaker tonight. By the amount of water here, it looks like he's going to be speaking for 6 to 10 days. So his name is Douglas Robinson, and I got a phone call from one of my clients in Northern California. And I don't say this in disrespect at all, but I get about 3,000 calls a year from somebody I'm supposed to meet. And so I said, I'll be happy to do it, but I don't know that I'll have the time. I've got to give a presentation, and we've got things going on. I'm trying to catch a plane. And she says, well, trust me, it's worth your time. And I said, okay, after the presentation, we'll all go to lunch together. And I was secretly thinking that he might not show up. And so we could just have a nice luncheon. As it turned out, he did show up for my presentation, came up after, introduced himself, and said, shall we go to lunch? And I said, yeah, that's okay, let's do that. And I was trying to be very nice and cordial. About 5 minutes into the presentation, I forgot I was eating, and I was just glued to everything he was saying. It was the most intriguing conversation that I've had in years. And he wasn't flamboyant necessarily, and he wasn't throwing things out that were crazy. He was just saying, you know, there's some trends that if you follow the trends, certain things happen. For example, and he gave us an example. I said, that's fascinating. He gave another example. I said, that's really fascinating. What do you do for a living? And then he gave me another example. And he says, what I do for a living is I teach and give presentations to government entities. So for example, all of you are going to write a big check this month to, no, not the IRS, this month. The property taxes. So the property taxes go in and they got to do something with the money. So there's a presentation that all these tax collectors will listen to, and it's Doug. He's going to tell them exactly what the trends are and what to watch for and what to be careful with, and based on what has happened in the past, this is going to happen in the future. Now, the interesting thing about Doug's presentation is, at least in my observation, he doesn't tell you what to do. He just tells you what has happened and what is likely to happen based on what's happened before, and he shows you trend after trend after trend. It's the most fascinating thing that I've ever seen. Now, for those of you who are interested, Doug has written a book. It's called Boom or Bust: Understanding and Profiting from a Changing Consumer Economy. And these are the types of trends that he's going to be speaking about tonight. And I really appreciate Doug coming down. He's coming down all the way from San Francisco to speak with us tonight. We're so grateful to have him with us. Please give a warm welcome to Doug Robinson.
Thank you, John. Wow. Now, I mean, you know, to be introduced by John, I've heard him speak a couple times now. I mean, he's the high bar. So parts of that when he's talking about, I'm thinking, God, I'm really glad I'm here so I can hear that guy. But wait a minute, that's me. So, and he talked about all these government agencies that I speak in front of, and I mean, they're all of us, they're like us, but they've got responsibilities for all this public funds, and so anytime they can get a little idea about how trends and different things can affect their life, and particularly the investments, because they are investing our money. When we pay our taxes, it doesn't all just get spent, it does get invested somehow. And so they want to be responsible for that. So I've had a great privilege of speaking in several of these groups. So I wanted to add to how also I'm up here, as John mentioned, a good family friend of mine called John when she learned that, you know, here's Doug, I've known him for years, and he loves to talk demographics to his government groups, and maybe that'd be interesting to have him come speak at one of John's quarterly functions like you're here. And I actually, as she's telling me this, wait, your estate planning attorney has a quarterly function where they have an interesting speaker, and it's not about estate planning. And she goes, yes. And then she says, she starts telling me all the other benefits she gets from this program that I've since learned is the life plan. And I asked her, I'm thinking, how much is that? That's got to be a lot of money. And so she told me, and I thought, wait a minute, I'm missing a zero there. It has to be more than that. So you all know, I mean, there's like quite a bit of value here, isn't there? I mean, this is a very expensive thing to have, to put on, and they do this all the time. So it's a great privilege for me to, hopefully I can add a little bit of value to what you're getting from this, and that unbelievable, it's a professionally mastered DVD that shows up in your mailbox. I mean, that's just incredible. So my conversation tonight, is trying to help you understand how to connect the dots between demographics, which is just the study of groups of people, to trends in the economy. Now, it kind of makes some sense. If you're going to talk about economy, you need people, right? You need people, you need money. Because if you're not talking about people and money, you're definitely not talking about the economy, you're talking about ecology. So, it's not plants and animals here tonight, this is about the economy. But you know what? We found out that as a group, we're fairly predictable people. Not individuals. I have no idea what you're going to do today or tomorrow. I guess we're all going to go to sleep tonight, I hope. But from day to day, I don't know exactly what you're going to do. But when you look at groups of people, we're very, very, very predictable. Now, when you begin this discussion on demographics, where do you start? Well, you've got to start. I can find one of these clickers here. You have to start at the absolute very beginning. Babies. You gotta have babies when you talk about demographics. Now this chart is taken from US Census and immigration data, and it shows that when immigrants to this country and US citizens were born. Now, you see that very large surge in the middle of this chart? That's between birth years 1936, peaking in 1961, interrupted by World War II, and that's the generation we always refer to as, you got it, baby boom. You're looking at one right here. I mean, this guy here, peak baby boomer, born in 1958, right at the top of that mountain. So everything I did, school, classrooms, huge, packed, everything. Get out, get the job market packed. So this generation has had an incredible effect on the economy. Now, let's go through this a little bit further. Now, between 1961 and 1972 or 3, there was a baby bust. Those are the X generation. But we actually returned up a little bit. About 1975, finally, the baby boomers' kids start to show up. And they peaked about 1990. A little bit of baby bust to 1996, if you're following me. And then at the way end of this chart, we had a nice little resurgence with a new generation. Now these are the baby boomers' grandkids, peaking so far in 2007. Unfortunately, we saw a big drop. And we have a big recession like we just have gone through, you kind of you stop having babies, but that won't last long. Because you're going to learn tonight that our echo boom generation, the baby boomers' kids, are going to be having more kids, and that's just going to go out and out. So we do have, and I'll call them what they should be called, the echo boom generation is going to be our saviors. So wherever we are today in our economy, it's really, really important to know when your next generation is coming. Because, again, we are very predictable. Now, let me show you why. This chart comes from the Bureau of Labor Statistics Consumer Expenditure Survey. That sounds pretty exciting, right? Kind of like government work. But actually, it's a survey that's being conducted for about the last 30 years. Now, the survey asks a lot of questions. And when this is all compiled, they know a lot about us. They know what we do, where we do it, from zip code to neighborhood block, and particularly at what age. So let me walk you through here. Now, this is average age. So don't feel bad as I walk you through this that you go, God, I did that. I'm incredibly average. And, I know I am. I've hit just about every, I'm going to try some of these gallons of water up here. I've hit that about every one of those things. So at the beginning, age 18, what do you have? Nothing. Finally, in your early 20s, you eventually get into the workforce. We hope, it's what you're supposed to be doing at least, age 25 on average, after you get kicked off your friend's couch or you move out of your childhood's bedroom, you get that first apartment at age 25 and a half. It's an odd time, but 25 and a half. You meet your perfect someone. You get married at age 26 for the first time. Now, I've been happily married for 25 years. I have no idea what the second time is, but there's a statistic out there somewhere. Now, at age 27, guess what? The baby comes. So on average, you have your first child. Now, you can tell by this chart, when that baby arrives, you're making money, you're spending money, you want to get out of the apartment, and so in your early 30s, you finally get that starter home. Guess what? You're making money, you hope, but you're definitely spending it because your child's forcing you to do that. And somewhere in your early 40s, it's about 44, when your child, or maybe you've got 2 or 3, are teenagers or preteens in that area, you want more space, you need more space, you get that McMansion. You get the biggest home of your life right about 44. Now, you're not through yet. You're still hemorrhaging money like crazy. And right about the peak of our overall family spending is in our late 40s. But again, you've borrowed a fortune to get there. So when you reach your late 40s, on average, you're in debt where? Right up to here, right up to your eyeballs. When you're at that age, on average, your kids start to leave the nest, you hope. They're heading out, right? And you just turn into, I've done my consumption, I don't need the stuff anymore, and someday I want to look out, gee, I want to retire someday. I can't keep spending money like crazy like this, and I just don't need the stuff. So at some point, I've got to start paying down my debt, and you start to do that. So you can do some other things, though, as you age in your early 50s. You go out and get that second home, that vacation home, and I don't know, maybe you want to lure your kids back to visit you with this vacation home, who knows. But you can see you generally stop or slow down in your spending. And you may, though, around mid-60s get that retirement home. You've downsized, right? Now, when you look at a chart like this, what side of this mountain do you think is best for the economy? The left side, where you're seeing here all this borrowing and spending and your family's forcing you to hemorrhage all this money? Or is it on the other side where you bought all this stuff, you don't need the stuff anymore, and you got to pay down debt because someday you want to retire? Well, clearly the answer is going to be, it's the spending side. It's great for the economy. When you're into paying down debts and saving and not spending, that might be really good for the capital markets, right? Because you're putting the money into the markets, you're putting it in the bank, and so there's lots of money available. But when you're reducing your debt, you're deleveraging or destroying that capital. So I'm going to give you a little clue where we are here today. When we think about this massive baby boom generation that's moving past this peak spending period and now is in this pay down debt, start spending less money. And this is going to be a big theme for us tonight. So I'm telling you, I have a lot of great information here that can make an optimist very happy. And I have some information here that make a pessimist very happy too. So let's go back to the beginning of this chart. Now, forget about how much you love your kids, but what are they doing before they leave the nest? They're like this: pack boys, pack girls, eating everything in sight, consuming everything. What are they producing? Right, zero. Absolutely nothing. You know, maybe when they're 7, 8, 10, 12 years old, they'll still give you a hug. Forget it when they're teenagers, right? And I found when our daughter now, she's in her 20s, big hugs because, of course, she wants more money. But the love's there. We know the love is there. But think about this in inflation terms. When you have all this consumption of these kids not producing anything, think about the 1960s and 70s, okay? This massive baby boom generation. consuming everything in sight, producing nothing. A generation that's 4 times the size of its parents, huge generation, small group of parents. It was simply that the parents were overwhelmed with all the consumption of the kids. What happened? Prices went up. So don't let the economists fool you that the textbook definition of inflation is too much money chasing too few goods. It really is, it's the inability of an economy to produce what it needs, what's required. Now think about this, when this massive baby boom generation gets into the workforce in the early 80s, and I'm that guy, right in 82, I'm the top guy. We all are piling into the workforce in the early 80s when, guess what? Remember, it was at the top of inflation. I started with a major brokerage firm in New York, which has since been bought up by another major bank. And at that time, back in the early 80s, we had a 20% money market rate. Could you imagine that today? Oh my God. We're lucky if we get 0.2. But it was that time where you had the maximum amount of inability or inefficiency to produce in the economy. That didn't last long. You had this huge generation that could finally produce whatever was needed, what's required, right? You had innovation, productivity, all these things. So what happened to inflation? All the way down. So we're basically over 30 years now into this whole disinflation period. It's a very powerful thing to recognize. So let's go ahead and look at this massive boom generation and what it looks like if we simply lag forward or push forward to that peak spending today. Now this chart, again, it's that immigration adjusted birth index, and this comes from Harry Dent. Now Harry Dent, I've been studying him for a long time. He's the first one that really connected the dots between demographics and the direction of the economy. He simply colored this chart red, pushed it forward to peak spending, and you look at that yellow line. That yellow line is the Dow adjusted for inflation. Now, it kind of makes some sense, right? That if you got fewer peak spenders in the economy, that eventually that shows up in the economy, and so it reflects in the stock market. When you have more peak spenders entering the economy, that gets reflected in the economy, and eventually it's reflected in the stock market. Now, if you see that center right there with a lot of volatility, the baby boom generation has reached its peak in spending, has moved past it, but there's a very volatile period here. You remember the first big bubble we had in the late 1990s, right? The tech boom, 2000. Everybody bought the internet stocks that, you know, at $10 is going to go to 100 when it went from 100 to 0. And we have that incredible drop. Now, what was interesting to me, you hadn't reached peak spending yet, so we knew that was going to come back. But we also had a Fed chairman back then, Alan Greenspan, who lowered rates from 6% to 1%. 1 sounds pretty good right now, doesn't it? To stimulate. Didn't really need to do that. Because guess what? We're at the age, this massive generation, that still is buying that big home. So interest rates, this is back in 2002, 2003, 2004, super low. And you had that super demand, right? And then you had a banking industry that said, oh, don't worry about it. You have a heartbeat, we'll give you money. So what happened to real estate prices? Perfect timing. Lots of money, lots of demand, prices shot up to the moon. And we kind of know how that ended, right? So you get this implosion down to 2000. We know about it from 2007, down to 2008, 9. And we're still trying to eke our way out of it. But you see that yellow line on the right? That's the Dow. The stock markets have just exploded on the upside. Okay? I'm going to end this presentation on the same slide because it's so powerful of what we may expect here, not just years down the road, but decades on out. So before I advance this slide, I want to have a little bit of fun with this consumer expenditure data, because it asks a lot of little interesting questions. So let me ask you this. What do you think the average age, the peak age of the head of household where there's the most amount of potato chip sales? How old are you? Now you don't raise your hand, just think in your head. Well, it happens to be 41. I mean, so what do? You've got a bunch of 40-year-olds sitting around the couch packing in the chips, right? Maybe. Sounds pretty good. But what's really happening, you remember you got married at age 26. Age 27, you had your first child. 14 years later, when you're 41, and your child's 14 at the highest caloric intake of its life, we hope. If they don't have any money, you've got the money and you're buying the chips. Okay, anybody here crazy enough to drive a motorcycle, to ride a motorcycle? Well, there's a very specific aggregate demand that's not showing up on this chart. There it is. Aggregate demand for motorcycles. Precisely entering our midlife crisis in our late 40s. Now, I don't know what happens when we hit 60 or 70. It just goes flatline. Don't know. You know, you bought that bike when you're late 40s. You go, wait a minute, this is pretty scary out there. I think I'm going to park it in the garage. If you're still there, parking in the garage. But you really want to still be out on the road. And you'd like something a little bit bigger. Maybe it has a bath. Maybe it has a bed. Maybe it has a bar. You get yourself an RV. She says, yes, there's a very specific demand. At a certain age, in our late 50s, early 60s, we go out and buy these really expensive things, right? And, you know, Winnebago knows this really well. In the last 3.5 years, their sales have quadrupled. And this is really during a pretty tough, challenging economic times, right? You know, $4 gas, $4.50 gas has come down a little bit. These things are super expensive to maintain and store, but it doesn't matter. At this age, you want that thing. Now, cars. And this is where the city governments that I work with really want to see this stuff, because they know in 2007 they were getting lots of tax dollars. You know, you had license fees and registration fees, sales tax. This is a real good moneymaker for local government. We knew, though, that when you had that implosion from 2007, when we were selling about 17 million cars a year, down to 11 million, that's a huge drop by 2009, we still had key aggregate demand in the system. We knew this was going to come back, and it did. Now today, you're actually back to about 16 million in car sales annually. That's a pretty big, comeback. But what's a little bit worrisome for me is that we're now back up to that total debt, borrowing or credit on auto loans. There's also been a doubling of subprime from 10 to 20 billion in auto loans. So I would suspect that we are moving past this peak age of our early 50s. And it might get a little more challenging, or at least that big momentum of car buying's behind us. But I also think, too, age 52, why do you go buy a new car? Why are you doing that? Well, I'm kind of thinking maybe it's logically, your kids are out of the nest, hopefully. You've been driving this beat-up thing for 10 years. And you go, wait a minute, I got a little bit extra money. I'm not spending it all on the kids. I'm going to go out and buy myself a car, a nice car with one key. That's it. You're not touching my car. Or maybe you buy 2 cars because they do come back and you want to put them in it and send them away. I don't know. So there's also an interesting demand for gasoline. We buy the most amount of gasoline in our mid-40s. If you think about it, that's kind of logical too, because you're in mid-40s, you still your kids are home, you've got maybe 2 people working, they're driving to work, back and forth to school, extracurricular activities, you're using a lot of gas. But interesting enough, as we age, we buy more gas out of town. Now, it was interesting because today someone said, oh, I know why, because you got the RV. You're filling that thing up with lots of gas, and it's kind of pretty close to that point, right there in our later 50s. But really, I think what it is, as we age and we're spending less money, we just don't want that stuff. Yeah, maybe the Winnebago and a few other things, but we want experiences. We want to get out of town, see something interesting, go interesting places, while we still can and want to, because you can see as we age, we don't do that. Now, one of my favorite slides, men's shirts. Men's apparel, for some reason, peaks also in our early 50s. Now, women's apparel peaks a little later, in our late 50s, so they look a little nicer later. Now, I was trying to figure out how to say this in a really nice way. Let's see how I can do this. Imagine, here we are, guys, we're 70 years old, 80 years old, you know. We're sitting there in our brown plaid shirt we bought decades ago. And you know what, let's be honest, we probably don't smell so good because we don't like to bathe. I tell this to the water folks today, and there's actually a slide I don't have here, but water use does drop off as we age. Might get up and flush the toilet a few more times during the night, but bathing is definitely optional. So anyhow, there we are. We're 60, 70, 80 years old. We're sitting there in our brown plaid shirt in our comfy chair. We're home. We're comfortable. What are we doing all day long? Drugs. Lots of drugs. Now, these aren't recreational drugs, I don't think. I mean, these are pharmaceutical drugs. And you know what? It's a pretty good deal that you want to buy these drugs, and the drug companies want to keep you alive so you can buy more drugs. So it kind of works out well, but basically, we just keep spending money to stay alive. Now, this chart actually, we could label this just general health care, okay? And we're going to kind of look at this here a little bit later as far as where health care costs are today and where they could go tomorrow. Now, while you're still in your kind of drug period, but you're still cruising kind of thing, you do want to be on a ship. Okay, cruises, right? Your mid-60s, I mean, they're kind of fun. Shaking your head, yeah, they're kind of fun. I've never been on one actually, but I hear they're great. And in our mid-60s, I've heard they're just easy. You just, you get on the ship and, you unpack and you go places that you don't have to move. You eat, drink, it's pretty easy stuff to do. So, and after that, we consume less cruising. But think about that last port that you're coming into. It's because it's coming someday, right? And what do? You go get yourself those other plans. I mean, you've set up your estate plan, you've done your trust, you got to make some other arrangements. And there's a very specific aggregate demand right there for that one purchase towards the end of your life. Now, as far as I know, there's not many repeat customers. So, these companies got one shot at you. Okay, let's talk about the health care. Now, this chart, it comes from the same one we saw when we started this conversation. This is simply the baby boom generation pushed forward to the peak of their health care consumption. And to be very blunt about it, you're peaking in your health care consumption right before you don't need it anymore. That's the way it works. So you can see by this chart that from now, just about now, out to really the late 2030s, there is a massive wave of baby boomers heading into their peak health care. And, when this whole Affordable Care Act discussion was going on, you could hear some of the politicians saying, well, gosh, health care inflation has been coming down. It's just not been as high as it used to. Well, some of that could you attribute to the economy. And some of it you could really attribute to there was less peak spenders consuming that product, right? So you had waning demand, but not many people are talking about really what this is going to look like later on. There is going to be an amazing nonstop thrust of demand here in the United States. So I honestly don't know how we're going to meet it, because this country, this wonderful country, this is the best country, the largest country, we are a fabulous country. But we spend twice as much money per capita on health care than Europe. And Europe lives longer than we do. And if you equate that to dollar amount, that's about $1 trillion a year more. That's a lot of money. I mean, it's not like a billionaire or a billionaire, but we're spending $1 trillion more for our health care. Now, if we were, living twice as long or all that great stuff, it'd be fantastic. But, this is the part of the speech that if you, want to be seeing half class full, you should be really happy about this, because this is kind of scary stuff. But when I look at other countries like Japan, they actually spend about 1/3 of what we spend on their health care, and they live the longest, actually. And that's where we're going to talk about a little bit about what other countries' demographics look like. I think it's kind of interesting to compare, right? So Japan used to be the second largest economy in the world, and they've been slipping, of course, because China's rising. But they also have a real demographic challenge. Now, this may look like the Golden Gate Bridge, but essentially what it is you've got two peak generations there. The one peak on the right, that generation's in their mid to late 60s. They drove the Japanese economy up in the early 80s, all the way to peaking in the 80s, and that big bust they've had since that period. And they did have like a mini boom just about the time we were having our bust in the early 70s, and those kids are in their late 30s now. But the problem Japan has, one of them, is they're not having any kids. I mean, there's a 40% decline from that peak 1970s born to today. Japan, unfortunately, has lost 1 million people in its population since 2008. Not a good thing. And actually, their birth rate is so low, this isn't funny, actually. In 3.5 generations, they'll have half the population they have today. So they need to really figure out how to get busy to get themselves out of this hole. And we write this in our book, is that Japan, my wife hates me when I say this, it's really the land of the setting sun. I mean, it's going to be really tough for Japan. Guess what size diaper they sell the most of in Japan? No, it depends, right? Did somebody say that? No. Anyhow. Italy. Italy, I love Italy. We love Italy. Who doesn't love Italy? I mean, come on. Great food, people, culture, history. Beautiful place. Crazy politics, worse than ours. But where's the love? I mean, I don't know what they're doing. They're not having babies. Kind of like Japan, they had a peak in their generation in the early 1970s, and they just stopped having kids. And I'm very worried about Italy. So as they advance, already today, Italy has half of, put it this way, there's as many people on their Social Security system, let's call it their entitlement system, they're retired, equals half of the workforce. And that's a scary thing. So, Italy has basically been in and out of recession for 10 years. And, I mean, this is not for this particular conversation, but they've been in this euro, right? They've been out of their own currency, and they're having a lot of difficulty competing with Germany because they can't produce like Germany can. So until they could devalue their own currency, but they can't make their exports more attractive. That's just another thing to think about. It's not just the demographics. It's also, boy, can they control their own currency? And they can't. So just another thing, kind of deviation from my demographics. China, you can't not talk about the world without talking about China. I mean, this is an amazing success story here, China has been. They're still, though, about half of the GDP of us here in the United States. They're approaching our level. Now, this is going to sound a little wonky if I tell you this, but purchase price parity, that's what economists love to talk about for some reason. And all that does is it equals another country's goods and services to what our U.S. goods and services would be valued at. That means they're doing really well. And they've been growing at, still today, about 7.5%. But China has some problems. Their one-child policy from the early 80s is going to catch up to them. In fact, you probably just heard they just changed their policy, have as many kids as you want, as they need them. Now, this is not going to happen overnight. I mean, China is still really concentrating on moving rural folks. I mean, they moved 250,000 from rural to urban areas over the last 15 years. They're trying to move another 250,000 in the next 15 years. That's kind of interesting enough. And actually, this is a little bit of a bubble story in real estate we're going to talk about in a little bit. But consider this. For some reason, China has 80,000 more, excuse me, I'm going to correct myself, 80 million more males than females. I mean, they got a little, where's the X chromosome here? And in fact, if you look at the recent statistics from birth to age 14, 17% more males. I don't know, they better change their water or do something different, but they're just getting it too much of an imbalance. 80 million males, that's twice the size of California. So anyhow, ready, available army, there it is. Scary. Mexico. Mexico looks actually pretty darn good. Lots of kids, okay? This is actually it's a country that's growing twice as fast as the United States. It has less than half the debt to GDP as a government in the United States. And actually, too, when you look at immigration statistics to the United States from Mexico, we're at a net zero. So this doesn't happen before. It's zero. Now, this is legal immigrants. I don't know what illegal immigrants is, but I would assume that there's less folks that want to come in here because there's more job opportunity in Mexico maybe than here. In fact, I kind of kid people. I said, we want to build this fence across our border with Mexico. Maybe Mexico wants to build a fence to keep us out. Interesting thought. My favorite demographics of the world here has got to be India. I mean, they've just never stopped having kids. And if you want to have a huge potential in an economy, you have lots of kids like this. And India is not a big country for its production. Its GDP is actually about the same size as what we spend on entitlements here in the United States. It's pretty small, but it is going to be growing and nonstop. India is really, again, this is a true success story coming. Indonesia, Brazil, parts of Africa, these other countries that have these very young populations and more, eventually are going to be great big powerhouses driving the whole world's GDP. In fact, studies, you can find these things all over the place, but Goldman Sachs did a study that today we're essentially 30% of the world's GDP is coming from these smaller countries. You fast forward to 2035, it's not that far away. You basically flip-flop that. These emerging markets, these developing countries will be 70% of GDP of the world, and that's shrinking the older developed countries like Europe and the United States, because our demographics aren't as good. Now, this is the kind of part of the presentation where I always have a little bit of difficulty with, because it's more for the person that wants to be happy with the bad stuff, okay? So it gets a little bit deep, but I'm going to try not to do that here. Let's try to be a little bit happy. And I really wish this debt chart had a credit assets, but it's not. It's debt. And we've got it's over $60 trillion of debt when you look at the consumer, the financial sector, corporation, and government. There is some good news, though, in this. If you look at the bottom of this chart, it shows us consumers. Now, in 2007, when we had this great big bubble, all these sectors were up, but look what's happening to the consumer. The consumer naturally is slowing down because the baby boomer is slowing down, buying less stuff. It's deleveraging. It's paying down debt. That's a good thing. Corporate America was for a little bit. They got such cheap money. Boy, they're putting it back on the balance sheet. And the financial system, well, the banking system had to contract. But who's making up all the difference? Yep, it's the government, the federal government in particular. That's us. That's our bill. And this to me is something that is going to stick with us for a while. And you know, debt in itself isn't bad. I mean, you know, debt is like, and I always try to come up with these metaphors. If you want to grow something, say a plant, I'm going to use this and see if I can stretch this somehow. You think of debt as the hole in the ground, the soil that you make. You put the seed, which is your idea. You want to buy a home, borrow money for a business, make an investment. So you've got that debt, seed, and you would grow. If it's done right, it's going to grow right. Now, consider if you have more and more debt, your hole is deeper and deeper and deeper and deeper. And that seed's way down at the bottom. It's not going to have a great chance to get out of that hole, and it may come out real spindly. I don't know if that worked for you. I've been trying to, you know, put that together in my head. I think it sounds pretty cool. Nobody's laughed, so I guess not. There, I got to laugh. But, you know, debt here in this country, again, we have added more and more debt, and we're not getting the growth out of it. Again, debt's not bad, but you got to get something out of it. So at some point, and I don't know when that is, I don't know if this is like the new paradigm and debt is it, and it's okay. We can just keep borrowing, and it's all going to work out just fine. Well, I'll tell you, many times we've thought that on other ideas, and, you know, it's not different this time. You know, reality does hit. So I would love to see us down the road either grow, obviously, faster than our debt, or at least start paying some of our debt down. Something to keep in mind. Now, this is another one of these charts on inflation, which I don't want to get too kind of crazy in this conversation, but I thought it was important to talk about inflation because it affects us, right? I mean, it's our purchasing power. And this chart comes from Doug Short, Advisor Perspectives. He does a really good job of compiling this data. And what I really want you to look at is on the left of that chart, in the blue, is actually what inflation has done since the year 2000 in aggregate. In other words, the CPI, which is the measurement for inflation that we use, is actually gone up 40%. So in other words, $1 of something that we bought in the year 2000 is now cost $1.40. Now, it doesn't feel like we've had that much inflation, but it's amazing how much that creeps. And of course, that your cost of living goes up, and unless you're making more money to offset that cost of living, you're kind of running behind. But what I also want you to point out on this chart that an inflation can be different to each of us. It depends on what we're doing in our life, how inflation affects us. Because there's 8 different components of inflation. Now, if you're buying a lot of men's shirts, hey, you're getting a deal because that price has come down. It's the only thing, it's the only component there is apparel that's actually come down in price in the last 13 years. But if you are using a lot of drugs, and medical costs are way above that whole aggregate, way above. And there's actually some outliers there like energy and college. They're actually not separately measured. They're embedded in the components. Oddly enough, college tuition costs is less than weighted 2% of the CPI. Now, wait a minute. If you got a couple kids in college, do you think you're measuring just 2%? No, 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 no. Your inflation rate, if you got a couple of kids in college, is unbelievable. And actually, a quick point on that is that, you know what the aggregate demand for college was? Huge in 2008. Because remember, 1990, that peak echo boom child was born. 18 years later, when they're entering the college system, you had the most amount of them going to school. And then, guess what? The government says, oh, let's give them lots of money. Okay? Borrow what you want. And guess what happened after that? The universities and college says, yeah, we'll take that money. And so today, oh my gosh, from 2004 to 2012, we increased our debt by 3 times. We're now up to $1 trillion in student loans. Now the good news here is if you got kids just ready to go to college, or maybe in a couple of years from now, your grandkids are, I would think the college costs will at least stop. It maybe even come down, because that generation's moved past that peak. And possibly, Technology will help a little bit. I mean, you really need to spend $50,000 a year to go to Stanford? I mean, come on. Isn't there an online course you can take? Isn't there something you can do? Can't technology help us with that? So I think that's going to be a combination that these costs shouldn't be quite as high. But you also see energy costs in here. Obviously, if you're driving a lot, that's going to affect you. Now, this chart just basically shows that education costs and healthcare costs have way exceeded the CPI index or inflation. Okay. Now, really, for most of us, if you're going to buy something, you need a job, right? Unless you're retired, you're living retirement income, you do need to have a job. Well, what's really interesting going on today is that the participation rate, now these are folks that are being counted as in the workforce, is now at the same level it was in 1978. Now, how in the world can that be? Has everyone just retired? I mean, seriously? Now, maybe lots of folks here are retired and you're not counted for good reason. You put your time in. But there's still a whole bunch of peak baby boomers that are not showing up in this count. And we also want to see who is coming into the workforce. So our baby boomers, kids, the echo boom generation, is entering into the workforce age right now in their 20s. And we had some promise there. You can see the right side of the chart, a couple big spikes this last summer and the summer before, but they haven't gone anywhere. Now, what's interesting to me is there's about 300,000 kids turning work eligible in their 20s every month. Yet, we hear this number that comes out the first Friday of every month, again from the Bureau of Labor Statistics, about the unemployment rate. You've heard that, right? And they always talk about this non-farm payroll number. Now, how many people work on a farm today? I mean, you really have to exclude the non. So anyhow, this is an old thing. They used to non-farm. These are basically people that are either getting jobs net, lost jobs to net that got jobs. And the number we had last month was about 200,000. Well, wait a minute. We got 300,000 kids piling into this workforce, right? Unless we got a whole bunch of baby boomers retiring, we've got to really get going to just break even. Now, unfortunately, or fortunately, we do have a population that's growing in the workforce. Thank God the seniors are working. That's great. It's one of the fastest growing sectors of all the age groups. What does that tell you? Well, hire a senior, get the job done. I think it's great. Forget the 20-year-olds. They think they know something, they don't know anything. So we've heard that the official unemployment rate is 7.3. Okay, that sounds pretty good. It's not bad. It's better than what it was earlier. But basically what I've done here is I've just added back in the people that have dropped out of the workforce that are no longer being counted. Then you actually end up with something north of 11%. Now, to Janet Yellen's credit, you've heard of her. She is going to be, most likely, our next Fed chairman. A couple weeks ago, she spoke a testimony with the Senate, and she'll be confirmed, there's no doubt. Ben Bernanke steps down January 31st. Well, she did say, when she was asked this question, what do you think the real unemployment rate is? And she said 10%. So it was refreshing to hear that, they're pretty much aware. I mean, if I can get this data, they can get this data. They know this stuff. But officially, Ben Bernanke today says, okay, we're going to keep interest rates at zero. They call it ZIRP, zero interest rate policy. This is our 5th year now, guys, 5th year of zero, until we see a 6.5% unemployment rate. Okay? Yeah. How long do you think we're going to have to wait for that? Probably quite some time. Because with all these kids coming into the workforce and people not stepping down or out of retirement, and we've got all this, I want to call shadow inventory of workers would potentially come back into the market if there's opportunity, that unemployment rate's not going down anytime soon. So you can think about investment-wise, let's not be too worried about interest rates all of a sudden going up and my God, I'm got to wait before wait for 10% interest rates. It's not going to happen. Okay, let's talk about one of our other favorite subjects, real estate. Now, wasn't it great from 2000 to 2005 and 6? If you were in LA, it was an unbelievable gain, 170%. This comes from Case Shiller, the numbers that come out every month. And when I see these numbers, I thought, oh my God, you know, you look at this data, you hear the data, and you plot the data, and you go, that's a mountain. And here in San Diego area, it's 150%, not bad. San Francisco, wait a minute, that's a real expensive city. It was only up a measly 120%. Well, it actually started from a much higher level than the rest of these areas. Now, unfortunately, we know the bubble burst, right? All these indexes dropped, as we know very well, about 40%. The good news is most of them are back. The San Francisco is back almost 50%. The other two areas, San Diego and LA area, are back a little bit under 40, in the high 30s. That's not bad. But I'll never forget, I started doing this demographic speech really in gusto back in 2005 and 6. And I had a lot of charts on real estate and when you'd buy and all this kind of stuff, feds and all the things we're talking about tonight, the banking system, what we could expect. And one particular slide I always used was where prices were relative to income. And it was just ridiculous how much little income you needed to afford this giant house. And so people would always say, well, how are my kids going to afford this property? I mean, they're never going to be able to buy a house. And I said, well, you never know. I mean, it could get a lot cheaper because either you've got to make 3 times as much money eventually to make up for that price, or prices have to come down. Sure enough, the bust happened. So today, where are we? I'd have to say that we're above equilibrium. That's just my take. And that here we've got this resumption, but I'm not convinced that we haven't completely seen the end of lower prices. I'm just not convinced because we have a Federal Reserve System which is shoveling money for free to all of us that can take it. It's an enormous financial engineering that's happening, again, by the Federal Reserve System. So I'm very worried that if that punch bowl gets taken away, what can happen? And by the way, here the statistics have been quite stunning on this recovery in real estate. It's not from you and me buying our homes. These are institutions buying these homes. These are hedge funds and large pools of money buying cash and renting them out. Smart buyers at the bottom. Now, what are they going to do when they want to sell? And who are they going to sell to? So those are just a couple things to consider. Now, where could maybe the next needle be to be the next bubble burst? Well, I'm going to go back and look at China again. If you look at China's largest cities, the price of the real estate to their income, they are enormous, like 30 times income. This is enormous. I look at a very expensive city like New York. New York's cheap compared to income. Well, you know New York's not cheap. San Francisco is 7 to 1. Down here in LA, 5 to 1. Sacramento, it's really cheap, 2 to 1. So its potential, this is something we got to watch for because, you know, what really busted the bubble, really was the cause of the bubble here in the real estate market in 2005-6, it was really 4 states. It's California, Nevada, Arizona, and Florida. When they started to implode, I mean, it took the whole system down. It took Europe down too. It took all real estate levels down. So is the next bubble burst coming out of China? Don't know. We're going to find out. But that's looking awful bubbly to me. And if you look at Shanghai compared to San Francisco, which is a really cheap place, right? Shanghai is just off the charts. In fact, after I put this together, I just came upon some data from the Chicago Fed and the Kansas City Fed on farm prices. Farm prices look just like Shanghai. I couldn't believe it. So there's been a massive buying boom in farmland in the Midwest. I don't know what's going on here in California because we do have farmland here, but in the Midwest it's been booming, and that could be maybe there's another little bubble developing out there. I certainly want to be a buyer today. Now, if I haven't actually put you to sleep, I'm going to do some more charting here. Good, you're still some voices I can hear your way. This chart I've been updating for a long time, 25 years of work here on this thing. And essentially, it's the 5-year treasury. It's the world that I live in for my government accounts, because we can only invest out to 5 years. That's just the way we work. But I could have done this for the 10-year treasury, which is what, when we borrow money for our mortgages, it's tied to the 10-year treasury. But it all looks the same. When the baby boom generation got into the workforce, could produce what it needed, what happened to inflation? It came down. So did interest rates. And all the way down here to this last 25 plus years, we've been in this really tight channel. We call it the downward channel. So sorry to be too technical with you, but this is really interesting, I think. So every time we've gotten up to this channel, interest rates went up, boom, back down. Now, one thing we really want to know with a chart like this is, when does that start to turn around? This big, huge 30-year price or rates coming down, when is it going to turn around and go up? Well, I don't think it's going to happen anytime soon. We've got maybe 10 years of like this. Really, it sounds like a long time, but this is really probably about another 10 years. Yes, right now the 10-year treasury, you've heard it's about 2.80. Maybe that goes to 3.5 or 4%. It sounds like a lot, but it fits within that channel. It's still very low. I mean, inflation is running a little bit under 2%. Actually, the last report was like a little over 1. We do have to worry about deflation. But still, these rates, because of where the baby boom generation is, where all this deleveraging is happening, where all that debt is, and we're getting less growth out of all that debt, these interest rates should stay low for quite some time. But I am going to tell you when interest rates are going to go up or could go up, and that's coming just here in a little bit. So, more charts, but they're important. And you know, when I put these things together, God, I start with like 60 charts. Now, you do not have the patience for 60 charts. In fact, when I was talking to John about putting this together, I thought, boy, I'd zip through this thing so quick. And as I was working through it, no, wait a minute. I had to hack out a lot of charts. Plus, I wanted to keep you awake. But this is really, really important chart. Okay, so bear with me on this one. This, again, comes from Doug Short, Advisor Perspectives. And you see the blue line? That blue line is the S&P 500. Okay? We talked about that first top in the year 2000, again in 2007. And guess what? We're back up there and a little bit higher. Now, what this chart is showing us, though, is what margin, in other words, institutions and individuals borrowing money to buy stock, when did that happen? It shows in red here. So in the first bubble we had in the year 2000, massive amount of borrowing to buy. I mean, think about it in real estate sense. Remember when people could borrow a lot of money to buy property? What did the property do? It went up a lot. Did that work out? No. Now, did it work out here in 2000? No. Did it work out here in 2007? No. Is it going to work out today?
Probably not.
Am I supposed to answer that? I'll tell you one thing. And this is just one piece of evidence to me what potentially can happen. If I have a 20 or 30-year time horizon, and I want to be, long equity, that's what they say in this business. You want to be involved in stocks because they're for the growth. I'd want to be really careful. Now, sure, if that's 20-year, goal, that's okay. But do I really have to be, irresponsible about it? No. So I'd just be really careful in here. And I used to say this when people say, should I sell my real estate in 2005 and 6? I say, if you don't want to sell your home, love your home. Really, really love it, because you're going to be tested with that love someday. So if you really, really love your stock, well, you might be tested with that love someday. And that's basically what this is saying. Now, thanks for hanging with me here on this, because this is another one of these wonky charts that Doug's got for you. I basically wanted to take the S&P 500, and I thought, you know what? I'm 55. I mean, honestly, I do. I want to be in this business till my 80s. I want to be active in something, and this is a fun thing to do. So where could potentially the stock market be when I'm in my 80s, 30 years from now? So all I did is that same chart we saw earlier about the channel chart. We saw the 5-year Treasury coming down. Did the same thing here on the S&P 500. Took all the way back to 1916. I took the peak in 1929. We all remember that, right? And the low in 1932. Boy, what a couple years that was. That's a 90% drop. I took the high in 2000, and actually on the low line, I intersected with 1941. It was another low, and I just made them parallel. Those are channels right there. Very easy to do. The middle line is, now again, bear with me, that's a regression line. Let's just call it an average. Now that average is just about the number you hear when you turn on the news or you're reading reports. It's about 5% per year without dividend. So if you include dividends, about 8%. We've all heard that the stock market goes about 8% on average, right? But you can see there are many periods where it goes really up and really down. But I want to cut to the chase on this. In 2045, that bottom channel, so let's just say in 30 years, this things are just not working out. We end in 2045 in somehow horrid conditions like we did at the beginning of the Depression in 1932. Let's just say that. The Dow, and this is an S&P, I'll put it in Dow terms, that's about 24,000 Dow. Now, today we're about 16,000 Dow. Okay, up 50%. Kind of sounds like a lot, but it's really not, because that's 30 years, so that's less than 1% a year. I mean, that wouldn't even keep up with inflation. That middle line, so that's that average, right, is 65,000 Dow. I kind of like that number. Sounds pretty good. The top channel gets a little crazy. That's 157,000 Dow. Love that number. Now, where we are today, we're a little above that average. At least we know over that long, long haul, these prices are pointing up. And that kind of makes some sense. People want better lives. They grow businesses. Governments grow, we all grow. This is what's going to happen. We will point in that direction. But are we overpriced today relative to what's going on? I mean, that's a question you really want to answer yourself. And what I needed to do in this chart, because sometimes I just get so overwhelmed with the bad news, I really needed to see how good it can be 30 years from now. So let's all stick around and see if this happens. Now, part of the work I do with the government folks is that they've got these pools of money. They've got a big liability. It could be, believe it or not, health care trusts. A lot of people don't know about this, but your local government actually has made a promise to their active and retired workers to cover their health care costs. And it wasn't until recently they didn't even have to account for that promise. So several years ago, GASB, the Government Accounting Standard Board, came out and said, wait a minute, you guys should probably start hiring an actuary and report this number. But the GASB never said you actually had to put money aside to fund it. Well, duh. I mean, eventually, if you made the promise, you better start putting some money away. So part of this whole thing that I work with is the demographics of the structure of these governments. We simply just match up where those demographics are to their liability. So it's real easy. And I'm just saying, I'm offering this to you so you can apply it to yourself personally. Obviously, if you've got a long-term liability or commitment, well, that can have a lot of risk. So that means a lot of equity or stock, right? If you are paying out that benefit to your current retirees, well, you can't take much risk with that. That money needs to be there. And so essentially what we do is we just identify the demographic distribution of the agency, and we just match up to that asset allocation policy. And we come up with one number. You can do the same thing. But, now here's the big but. You can't blindly do this stuff. I'm not going to say that, gee, if I'm doing this personally, the next generation, I'm saying that's 30 years from now, Okay, great, I want my grandkids to have this set of money. Okay, I'm going to buy 100% stocks. Now, maybe in the long run, I should do that actuarially, but knowing what I know today, I want to make sure I write my own investment policy to give myself some room. If I want to say, markets are way overvalued, I don't necessarily want to be 100%. Maybe I want to be 20. So this is just a way to say you can be structured about what you do, but give yourself some room in that structure. And thanks for bearing with me on this chart. That's a little wonky for us here, but I thought it was important to share. Now this is the chart that I'm actually coming into my close. Now maybe, John, I did go a little shorter than I thought. I thought I was going to be here for an hour and a half. Thank God, aren't you guys lucky? I haven't even finished all my water yet. But this chart, to me, is just so powerful. Again, it's the Immigration Adjusted Birth Index simply legged forward to peak spending. And this peak spender is through spending. I'm done. I don't want anything more. Let's get rid of debt, pay down debt. That's what we want to do. Have experiences, take nice vacations, but we just don't need the stuff anymore. And you've got millions of us baby boomers doing that. I mean, think about this. Let's say you're 65 or 70 and you're lucky enough to win the lottery. Great, right? What are you going to do with that money? Nothing, really. I mean, you're not going to spend it. You just won't. Be honest. Pardon me? Going to try. Well, maybe he's going to try, but he really won't because he's so reluctant to spend. He won't spend. Now, because he really doesn't need anything. He's got everything. He put it in the bank or whatever he's going to do. But guess what happens if your son or daughter or your grandchild, 30 years old, won that money? It's gone. So think about that again in relationship to the economy. Again, as we age, we just spend less money. We really need that next generation to really get us going, okay? What this is telling us, though, is that from here out to about early 2020s, we have the fewest peak spenders in the economy, okay? There's a little bit of a tick up around 2016, but the lowest amount, or the fewest amount of peak spenders in the U.S. economy won't happen until the early 2020s. Okay? So that must make a pessimist really happy. Now, here's the good. Here's the real good. Remember those kids that we had? Oh my God, thank God they are going to be our saviors. I mean, hey, it's Christmas time coming up. Thank God we've got a savior. These kids are going to starting about mid-2020s on that same massive cycle their parents had been on. This hemorrhaging of money, this necessary family spending. And really from the mid-2020s out to end of 2030s and the 2040s. So to me, that's going to be a wonderful time for the U.S. economy, and that can sit on top of this incredible emerging markets, developing market story, the Indias and Brazils and the Indonesias, Southeast Asia, Africa, not Europe. They're old and getting older, but these other countries. And so I want to be really, really optimistic 10 years from now. So we got a little bit of time to kind of work our way through. So I think when the invitation went out, I think there was a couple questions on there. Would I be able to afford my health care? And I guess the quick answer I would have, if I can answer that, is if you're 65 or older, you're on Medicare, you're probably okay. Put a little bit more money aside for stuff that's not paid for. If you're my age or younger, you better start putting away the money. Because there's no way those healthcare costs are going to go down, even if we get really smart in how we're going to deliver it. Okay, because these costs are going to go up. I don't care if you think that healthcare should be delivered by the government. they tell us what to do, where to buy it, when to buy it, and they deliver it to us. Or if you're free market, I want to buy when I want to buy it, where I want to buy it. If it doesn't matter where you sit in that argument, you've got this huge aggregate demand for healthcare from here all the way out until the late 2030s. So again, the younger you are, the more you want to put money aside. So you know that at age 45, you spend twice as much money on healthcare as 25. Age 65, you spend twice as much money as 45. At age 80, you spend twice as much money as 65. It's that same chart. It's like this. So Social Security, I think that was one of the questions. Will Social Security be around? Well, when we started the system back in 1935, there was an infinite amount of workers per, collector, right? Just started. By 1950, we had 16 workers per collector or retiree. Let's say retiree, not collector. And today you're at 3.3. Okay, so it's going down. But yeah, and Social Security, it doesn't really have a trust fund. It's just another tax, okay? But we did have a surplus up until about this year. Medicare, Medicaid, forget it, that's toast. But because we're going to have to fund that. That's just, we're just going to have to pay more taxes. There's just no doubt about it. But I don't think that Social Security is a problem for people today or even a couple years younger. Now, for me at 55, if I'm fortunate enough to still be making a reasonable amount of money in my life, maybe, that should be somewhat tested, means tested, right? It's only kind of fair. And so hopefully systems like that come in. I don't know my daughter's age. I mean, she just better start saving now for everything. But if you're old enough, I don't think between Social Security, which by the way is still going to be a 2-to-1 ratio, 2 people paying in for 1 collecting, even out 30 years. That's what the stats say. Although, the surplus we had is gone. So, I look at the stats, but still the surplus is gone. So anyhow, I'm not that worried about Social Security collecting it, but it should be means tested. Inflation, we talked about that. Can we have 10% inflation? No. No. Our biggest worry is deflation, okay? Because when you have this enormous amount of debt, you're getting much less growth out of it, okay? Plus you've got this whole aggregate demand thing going down. I mean, look what the Federal Reserve System's doing. They're keeping rates at 0. Now that's free money. That means you can have an unlimited amount of money. But what's happening to that money? It's not going anywhere. There's a thing called velocity. That's just when you put money in the system, it spins around quickly. That's really good. It's changing hands. The velocity numbers are just going like this. The money comes in, it's not going anywhere. So it's really a deflation worry, and that's why the Federal Reserve is keeping interest rates at 0, because they want to reinflate. Okay? So therefore, interest rates should stay low considerable amount of time. 10 years, maybe more. So, but then I was saying, what could happen later? When you do get this boom coming from the echo boom generation, at the same time the world is booming, that's going to be really interesting. Maybe there's challenges to natural resources. I could see then you start to build some inflation. So maybe 2025, 2030, we're 4, 5, 6% inflation. I don't know. Maybe technology will offset that all. Who knows? Because technology obviously is doing a lot for the energy sector. My God, you could design, build, ship something faster than any time in history. I mean, I'm reading books now where these people, this one guy that, and I can't recall his name, he coined the word nano, help me out there. Yeah, like nanotubes, nanotechnology, right. He believes that we'll build machines atom by atom. And so you're taking raw material, basic raw material, and you're building these machines. So you could, one of his examples, you could create a car in a garage because the machines are so small, atom by atom, it just gets bigger until you create it. So already today we have 3D printing. You have the software, you can print. These things can print metal. You can print a gun. So maybe you don't even have an Amazon because you just go to your computer and say, and it makes it. So I would imagine that would keep costs down. And of course, the healthcare, though, thing, yeah, it'd be great. Society keeps us alive, the technology keeps us alive, but you know what, that's going to be costly too. So maybe the effects of all this great innovation is going to be actually more expensive down the road, something to think about. We talked about real estate prices. Maybe we bottom, maybe we haven't. I'm not 100% sure we're going to go back down, but I wouldn't believe you're going to see these same kind of gains we've had in the last couple of years. Free money policy again. And then, of course, the stock market, I think you know my views on that. You got to be extraordinarily careful. Like I said, if you love your stocks, you might be tested on how much that love really is. I think really when you end a conversation like this, it's really about call your kids or your grandkids, tell them you love them, and then don't tell them you're going to send them more money. Don't do that. Although they could, if you do give it to them, by the way, I'm going to change that. If you give them money, that's great because they'll spend it right away. So maybe I should change that. But please do tell them to have lots of kids. We need those kids. We love babies. So, and with that, you guys have been great. Thank you very much. You're a terrific audience. Thank you very much.
That was wonderful.
Oh, thank you, John.
And now you know why the government has Doug come and speak. Do you have any idea how much time it takes to do the research, gather the information, produce those charts? I mean, this is overwhelming. Do you understand what I said earlier when I said I forgot I was eating lunch when I was visiting with him? I mean, he didn't have any of the charts there, and he's just telling me this stuff. It's incredible. By the way, before Amazon shuts down based on your prediction, if you go to Amazon.com and you put boom or bust, his book pops up. So there's a greater title, Boom or Bust, Understanding and Profiting from a Changing Consumer Economy. But you just put boom or bust, his book pops up. Now, would you share with them what you shared with me about your daughter? This has nothing to do with his presentation. It was very interesting. Go ahead.
Oh, well, it's just our daughter. I was just telling John, sometimes you want a personal story. So I've been married for 25 years to Mary. And we have one daughter, and she's our precious thing. And she, thank God, she graduated from high school. This is a private school right now, you know, because thank God, in 3 years she graduated from high school. And then she got accepted in 2 conservatories in Paris. So she's been in Paris now for almost 4 years, bless her heart. But
and she's spending in the wrong country.
Yeah, she's spending in the wrong country and she's spending Dad's money. But we're trying to close the bank of Dad's door. Okay? I said, it's time to get some more students in there and we'll move her to a cheaper price. It's time to get off the, you know, so we're trying to do that job.
So maybe we can have her come and give a concert for us next
She'd
time
love that.
at one of our meetings. Would that be good? Would you like that? All right. Well, Doug, we have a small gift for you. It's small compared to all the information you've given us, but thank you very much. We hope you enjoy that with your family. Thank you very much.
You're very kind.
And would you join me in thanking him again? Thank you, Doug.
You guys are great.
By the way, I have asked Doug if he would hang around a little bit. So if you want to just hang around over here, if you have questions about his information, the consequences and those types of things, I've asked him to stick around at midnight. He has to say goodnight. I told him no later than midnight, okay? Thank you very much for coming. Have a safe and careful drive home. Good night.